Hello Option Master subscribers, welcome to Lecture 8. My name is Asad Tasani. This lecture is called Option Greeks. So in this lecture, we're going to be going through the option Greeks. Now if you don't know what these are, that's fine. We're going to explain them from the beginning. And what we're going to do is we're going to talk about the 5 Greeks that are listed here. So these are delta, gamma, vega, theta, and rho. We'll go through each one, what it means, how it works, and how to calculate them and use them in practice. And this lecture, once again, will have an Excel component to it. So the first half of the lecture, we'll be going through conceptually what each of these Greeks are, what they mean. And in the second half of the lecture, we're going to actually calculate them in Excel and use them and see how to use them in practice and what we can learn from them. Okay, let's get started. So what are option Greeks? Option Greeks, first of all, the fact that we have the word Greeks, that refers to the fact that all of these things are named after Greek letters, right? Delta, gamma, vega, theta, and rho are all Greek letters. With the exception of vega, that's not a Greek letter, but it's still called a Greek. The other ones are all Greek letters, so that's where the name comes from. And what these Greeks are doing is that they measure how the price of an option changes when other parameters change. Okay? So what is a parameter? A parameter is an input into an option pricing model. Okay, so take for example the inputs into the Black-Scholes model. So perhaps the simplest input is the underlying stock price, right? If you remember last time when we were calculating the price of an option using the Black-Scholes model, we had to enter in various different parameters, right? We entered in the stock price, we entered in the volatility, we entered time to expiry, and so on. So all of these things are parameters that we enter in to come up with the option price. So a parameter can be any one of these things. A parameter can be the stock price, a parameter can be the interest rate, it can be the time to expiry, and so on. What these option Greeks are then doing is measuring how does the price of an option change when these other parameters change. Right? So for example, how does the price of the option change when the underlying stock price changes? That would be one of the Greeks. Okay? Now, one of the key things to remember about these option Greeks is that they're asking what happens to the option price when a parameter changes, but other parameters are held constant. Okay, this part is quite important. And what it means is that when we say that, the option will increase by 1% when the stock price changes, we're assuming that nothing else is changing at the same time. Okay, so anytime we're looking at these Greeks, we're saying how does the price of an option change when these other parameters change, we're only looking at changing one parameter at a time. Right, so either we're changing the stock price and seeing how the option changes, or we're changing the interest rate and seeing how the option price changes, and so on. Right, but we're only changing one thing at a time. Right, so we're saying what happens to the option price if I change the stock price but I keep everything else the same? Or what happens to the option price if I change the interest rate but keep everything else the same? Okay, so that's what these Greeks are telling us. The option Greeks all come from the Black-Scholes model, and as we talked about last time, the Black-Scholes model is not completely accurate. It's a reasonable approximation in most situations. So you have to take these Greeks as being approximations as well. All right, they're not hard and fast rules, they are approximations only. They're only as good as the underlying model, right? So however good Black-Scholes is, that's how good the Greeks are, right? Which means they're useful, but they're not going to give you the exact answer, right? They're approximations. So the first Greek we'll talk about is called delta. This one is by far the most important one. It's the one we'll spend the most time on as well. So delta measures how the price of an option changes when the underlying stock price changes. Alright, so this is very intuitive, right? We're saying when the stock price changes, what happens to the value of the option? Mathematically, this is the derivative of the option value with respect to the stock price. Okay, so if you take the Black-Scholes model and you take the derivative of the Black-Scholes model with respect to the stock price, you get delta. Again, you don't have to worry about the math. I'm going to mention them for each of the Greeks, but that's just for your information only. You don't need to worry about how to actually do that. So delta is a number that's going to be between 0 and 1 for call options, and between 0 and -1 for put options. Alright, so if it's between 0 and 1, that means it's positive. That means the option price increases when the underlying stock price increases. If it's negative, it means the option price decreases when the underlying stock price increases. Alright, so call options always have a positive delta, and put options always have a negative delta. And we'll see a couple of brief examples. And one thing I'd like to point out here, and this is actually true for all the Greeks, and delta is valid only for small changes in the stock price. Right, so if you see a stock's delta, it's going to tell you how much the price of an option changes when the underlying stock price changes. It's only going to tell you that for if the stock price changes by a small amount. Alright? And the smaller the amount, the better the better delta is as a measure of that change. Right? For large changes, these Greeks are not valid. Okay, so they're only valid for small changes in the stock price. And later on in Excel, you'll see what we'll actually show some numerical examples and see what we mean. Okay, so let's go through a mechanical example of delta and how exactly we can interpret these numbers. Suppose that a call option has a delta of 0.5. Right, now remember that call options always have deltas between 0 and 1. So if the call option has a delta of 0.5, what does that mean? It means that when the stock price increases by 1, the option price increases by 0.5. Alright, so all of these deltas are saying what happens to the price of the option when the stock price increases by 1. Okay, it's always going to be 1 for the stock price change. Right, so if the call option has a delta of 0.5, what this means is that when the stock price increases by 1, the call option is going to increase in value by 0.5. Now it makes sense that a call option should always have a positive delta, right? Because when the stock price goes up, call options become more valuable, right? Remember that a call is an option to buy at a fixed particular price. So the more valuable the stock is, the more valuable that option becomes. Right, and that's why call options have a positive delta. Alright, so when the stock price goes up, the value of the call option also goes up, and it'll go up by whatever delta is. Now you could have a delta of a call, for example, that's say very small, like 0.1, in which case when the stock price increases by 1, the option price would only increase by 0.1. And this means that the option is not very sensitive to changes in the stock price. Now on the other hand, you might have a delta close to 1. You could have a delta of 0.9. And this would mean that when the stock price goes up by 1, the option price goes up by 0.9. In that case, the option is very sensitive to changes in the stock price. Right? So this number is also measuring how sensitive the value of the option is to changes in the stock price. So that's a call option. Now let's think about the example of a put option. So suppose a put option has a delta of minus 0.3. Remember that put options always have delta that's negative. Alright, it's between minus 1 and 0. So how can we interpret this? The way to interpret this is that when the stock price increases by 1, the option price decreases by 0.3. Right, so the reason we have decrease is now because the delta is negative. Right, so if the stock price goes up by 1 rupee, then the value of the put option will fall by 0.3 rupees. And like with the call option, we can have varying sensitivity of the put option to the underlying stock. Right, so if for example the put option has a delta of minus 0.9, then it's very sensitive to changes in the stock price. Right, when a 1 point increase in the stock price would lead to a 0.9 decrease in the option price. Or you could have a put option which has a delta of minus 0.1, or not very sensitive. In that case, a 1 rupee increase in the stock price, the option price would only decrease by 0.1. And finally, the reason that a put option has a negative delta is because when the stock price goes up, the value of put options become worth less, right? Because it's an option to sell. So in practice, what does delta actually come out to? So delta will take a wide range, okay? Delta will typically, always, as I said, it will be between 0 and 1, but there are certain deltas you'll come across more frequently. So at the money call options have a delta that's close to 0.5, okay? It may not be exactly 0.5, but it's close. Out of the money call options have a delta that's close to 0, and in the money call options have a delta close to 1. Right, so what does this mean in practice? Well, if you have an option that's at the money, it means that for every 1 rupee increase in the price, the call option is going to go up by 0.5. Now, if you have a very out the money option, then the delta is close to 0, and the option is not very sensitive to changes in the stock price. Right, the stock price may move, but the option won't move by very much. On the other hand, if you have an in the money call option, these have deltas close to 1, and the more in the money you are, the closer the delta gets to 1. And once the delta is close to 1, it basically means that it kind of moves in line with the stock price. Very, very similar. With put options, the same logic is going to apply. So an at the money put option, at the money put options have a delta close to minus 0.5, okay, for the same logic as the call options. Out of the money put options have a delta close to 0. So in this case, they'll still be negative, but they'll be close to 0, say minus 0.1 or minus 0.2. And then in the money put options have a delta close to minus 1. Okay? And again, this is basically a situation where the stock is going to move exactly opposite to the option, right? Because it's close to minus 1. So the same principle applies. And I think one nice way of interpreting delta is that you can think about it as the probability that the stock ends up expiring in the money. Okay? So let's take the example of the call option. So suppose you see an at the money call with the delta of 0.5. This means there's about a 50-50 chance that the stock will end up expiring, the option, will end up expiring in the money. And that kind of makes sense, because if the option is at the money, that means it's right at the boundary, right? It could expire just below the strike, or it could expire just above the strike. So it could go either way. So then the delta is going to be around 0.5, right? 50% chance that it will end up in the money. Now suppose you have an in the money call option. An in the money call option is going to have a higher delta. And naturally, an in the money call option has a greater chance of expiring in the money, right? Because it's already in the money. So the chance that it will expire in the money is high, right? So when you see a delta that's very high, that means there's a higher probability that the option will expire in the money. And finally, if you had a delta close to 0, that's an out of the money call option. And because it's out of the money, its probability of ending up in the money is very low, right? And that's why the delta will be 0, or close to 0. So that's kind of the best way to interpret this actual number, right? Think about it as a probability that the option ends up expiring in the money. Now there's one thing to note, is that if you're doing this, you're going to have to look at the absolute value of delta when you're looking at the put options, right? So the put options are negative numbers, but you just take the absolute value, right? So an at the money put option is going to have about a 50% chance of ending up in the money. Let's say an in the money put option has a delta of minus 0.8. That means there's an 80% chance that it will end up expiring in the money. Okay, so absolute value just means you get rid of the negative sign, and then you'll get the probabilities. And otherwise, it's identical to the way you would interpret the call options. And delta is very important. It's particularly used when we do things like delta hedging. That's a topic we'll look at in a future lecture. Delta hedging means we try and keep the delta as close to 0 as possible. That's something we do at Income Alert already. And basically what we're doing is we're just going to make sure that the sum of all the deltas is close to 0. And that's what delta hedging is. But again, that's for another lecture. And so in the second part, we'll now go through the other Greeks. So we'll go through the remaining 4 Greeks now. These are gamma, vega, theta, and rho. All of these are probably a little bit less important than delta, but they're all still very important. So the first one we'll look at is called gamma. Gamma measures how the delta of an option changes when the underlying stock price changes. So there's a subtle difference between gamma and delta. Right? Delta is looking at how the value of the option changes when the underlying stock price changes. Gamma, instead of looking at the option value, is looking at the option delta. So it's saying how does the delta change when the underlying stock price changes. Mathematically, it's the second derivative of the option value with respect to the stock price. Or equivalently, the first derivative of delta with respect to the stock price. Alright, so it's looking at how does delta change when the stock price changes. And gamma is always going to be positive for long option positions and negative for short option positions. So this means that for both call options and put options, if you own a call or own a put, gamma is positive. If you're short a call or short a put, then you have negative gamma. Okay? So gamma is positive for both call and put options. Short positions are obviously then negative. Let's go through let's try and understand how exactly this works. So let's take the example of a call option. Alright? Now a call option has a delta between 0 and 1. Alright, suppose we have an at the money call. So the delta is 0.5. Okay? And we want to know what's going to happen to the delta as the price of the stock goes up. Now we know that an in the money call has a higher delta, or a delta close to 1, as compared with the at the money call. Right, so the at the money call has a delta of 0.5. The in the money call is going to have a higher delta. Now when the stock price goes up, that option goes from being at the money to in the money, right? So when the stock price goes up, the delta is going up as well. Right, so the delta might go from 0.5 to 0.7 when the option goes from at the money to in the money. Right, so when the stock price goes up, we can see that the called option delta goes up as well. Alright, so that in that sense the gamma is positive, right? Because it's telling you that delta goes up when the stock price goes up. Right, so for a call option, gamma is positive. And then we'll also see that the same is true for a put option. When the stock price goes up, the delta goes up. Okay, so let's imagine this time we have an at the money put option that has a delta of minus 0.5. Now what happens to a put option as the stock price goes up? Well, it starts becoming out of the money, right? And the delta of that put option starts going towards 0. So what happens when the stock price goes up is that the delta would go from, say, minus 0.5 to minus 0.3, right, for the put option. Now this is an increase as well, okay, because a change from minus 0.5 to minus 0.3 is an increase of 0.2. Alright, so even though we have negative numbers, we're still looking at, we say that that's an increase, right? So minus 0.5 to minus 0.3 is an increase of 0.2. Alright, so even though the put option is becoming out of the money, its delta is actually going up as it becomes out of the money, right? Because it's increasing towards 0. Okay, so now we can see how in both cases that as the stock price goes up, both the call delta and the put delta will go up as well. A final point for gamma is that it tends to be highest or greatest for at the money options, and it falls as an option goes further in the money or out of the money. Right, so once an option is very in the money or out the money, the delta doesn't change as much. Alright, so imagine if you had a in the money call option with a delta close to 1. If the delta is already close to 1, then it can't really go that much higher, right? If the stock price keeps going up. So this is why the gamma is smaller for in the money and out of the money options, and large for at the money options. Okay, the next Greek is called Vega. So as I said, Vega is the only one of these that is not a Greek letter. I don't know why it's still lumped in the category of Greeks, but it is. So Vega measures how the value of the option changes when volatility changes. Okay? So, for example, let's say you have a stock which has a current volatility of 20%, and based on that volatility you get some option price. Now suppose that volatility were to go up from 25 to 26%. What's going to happen to the price of the option? Okay? Mathematically speaking, this is the derivative of the option value with respect to the volatility. Right? So it's saying how does the option value change when volatility changes. So let's take an example. Suppose an option has a vega of 2. What this means is that when volatility increases by 1%, the price of the option increases by 2. Okay, so imagine volatility goes from 25% to 26%. That option price is going to increase by 2 in response to the change in the volatility. Now, as you know, option prices increase with volatility. That's true for both call options and put options. And we've seen this already a couple of times. We saw it last time when we looked at examples of the Black-Scholes model, how when you increase volatility, both the call price and the put price went up. And then we also saw it in the lecture before that when we looked at the simple option pricing model and how higher volatility would increase the value of the option, whether it's a call option or put option. So this means that vega is going to be positive for long option positions and negative for short option positions. So if you own an option, then you are long vega, which means that as volatility goes up, you make money. As volatility goes down, you lose money. So when you're doing something like trading volatility, what we're basically doing is that we're making a bet on volatility going up or down. Right? So a long option position is long volatility, right? So it's long vega, which means that as volatility goes up, the value of the option goes up, right? So that if you'd buy an option if you want it to be long vega or long volatility. And likewise, if you want it to be short volatility, you'd want negative vega, so then you sell an option. If you sell an option, your vega is negative, which means that when volatility goes up, you lose money, but if volatility goes down, you make money. Okay? So that's vega. So this one's quite important because, you know, it's typically options and volatility have a very strong relationship to one another, and you know, different options will have different vegas. So some options may be more sensitive to changes in volatility than others. And the actual value of vega will depend on other factors, whether it's at the money, out of the money, in the money, whether it's near expiry or far expiry, and so on. There's various factors that would affect what vega is, but it's certainly useful for understanding, you know, how exposed are you to changes in volatility. The next Greek is called theta. Theta, I think, is one of the most misunderstood of the option Greeks, and I'm going to explain to you what it is, and I think hopefully maybe clarify some doubts that often people have on this. So theta measures how the option price changes as time passes. Okay? So it's also sometimes called a time decay. And mathematically speaking, it is the derivative of the option value with respect to time to expiry. So we are asking, how does the value of the option change as time to expiry passes? So theta is always negative, and this means that the option will lose value over time, assuming everything else is constant. Now this component is quite important, the idea that everything else is constant. Right, so what this means is that an option is going to fall in value assuming that nothing else changes. Alright? And in particular, it's assuming the underlying stock price does not change. Right? That's very important. Right, so when we talk about option decay, that option decays, but the theta it'll only decay by that theta if nothing else changes, right? So if from one day to the next the stock price stays exactly the same, okay, so from one day to the next the stock price doesn't move and nothing else changes, then the value of the option will fall by the theta. But of course, in practice, everything's not always constant, right? If the stock price were to change, that could also change the value of the option additionally, right? So just because an option has time decay doesn't mean that it always loses money. And I think this is the confusion that sometimes comes up, the idea that all options decay. That may be true, that all options have a decay to them, but they don't all expire worthless, right? They might expire more than what they're worth today, because there are other factors that affect the value of the option, right? Theta is not the only one. So suppose you saw a theta of -3. What this then means is that the value of the option will fall by 3 over the next day, assuming that nothing else changes, right? And in particular, assuming that the stock price doesn't change, right? So if the stock price doesn't change, if nothing else changes, and the option has a theta of -3, then the value of the option will fall by 3 the next day. Theta is also related to time to expiry and moneyness. So theta tends to be highest for at-the-money options. Okay, so at-the-money options have a high theta or a high decay. Out-of-the-money options have, and in-the-money options have a lower decay. Theta is also large for options that are close to expiry. So the closer you are to expiry, the greater that decay is, the greater theta is. And again, this doesn't mean that if you want to earn theta, you should always sell options that are very close to expiry, or always sell only at-the-money options. Theta may be large for these, but there's a flip side to it, where even though theta is large, there are other factors actually move the stock price in the opposite direction, right? So the gamma is also higher, for example, for at-the-money options, and that will actually work against you if the stock price were to change, right? So don't just assume that just because an option has a larger theta, then it's going to earn more decay. There are other factors involved, right? So theta is only telling you what's happening to the price of the option, assuming nothing else changes. Okay, and that's, I think, the important thing to remember about theta. The final Greek we'll look at is called rho. Rho measures how the option price changes as interest rates change. So this is the derivative of the option value with respect to the interest rate. So take a numerical example. Suppose rho is 0.1. Then if the value of the option would increase by 0.1 if the interest rate were to increase 1 percentage point. Okay, so say the current interest rate is 7%, and rho is 0.1. If the interest rate would go from 7% to 8%, then rho would the option price would increase by 0.1. Now it's important to remember is that rho is very small, particularly for short-dated options. It's actually not used very often, so traders rarely need to use it. It is applicable if you're trading long-dated options. Okay, so if you're trading options with long maturity, say 1 year or more than that, then rho becomes quite relevant. But when you're looking at short-dated options, because the sort of effective interest over a short period is so small anyway, that the impact of changes in the interest rate on the option price is really small. So in my eyes, you don't really need to worry about this Greek. I've included it for completeness because it's what is commonly done. But this is not something that most traders use. I certainly don't use it. You would only really use it, as I said, if you were trading very long-dated options. In part 3 of this lecture, what we're going to do is we are going to actually calculate the option Greeks in Excel. And I've printed the formulas here for you. These are the call option Greeks, and the next slide will be the put option Greeks. And this is really just for your reference only. I don't intend to go through this. It's just it's all the same parameters from the Black-Scholes model. So all of these things we use to calculate the Black-Scholes model and the option prices from that. And it's just the same variables with various different formulas. And if you're interested in this, then you can use it. And these are the formulas I'm using in Excel as well. But again, I'm not going to actually go through each calculation because it's a bit tedious. This is just for your reference. So these are the call option Greeks, and then this slide here is the put option Greeks. Note that the formulas for gamma and vega are the same for both calls and puts. Gamma and vega is the same for call options and put options. The others, delta, theta, and rho, they're very similar. The only difference is that you'll find some of the signs are switched. So in some areas where you had positive signs, you get negative signs, and vice versa. So that's really the only difference between calculating this for call and put options. Just some changes in the sign, but otherwise it's pretty similar. Okay, so now what we'll do is we'll go into Excel and we'll actually just calculate some Greeks for some options and see how they work. Alright, so now we are in Excel, and I'm actually building on the spreadsheet we did last week. So last week we had this Black-Scholes tab where we just calculated the Black-Scholes formula based on all these parameters. And now I'm just adding to that spreadsheet. So again, this will be available for you to download. And what I've done is I've just calculated the call option, all the Greeks for each of the call options. And the formulas for these are the same as what I just listed on the slides. And they're all based on these parameters down here, okay, that we used last time. So the entire formulas are always just combinations of these parameters. Some are a little more easy, some are a little more complex. So delta is very straightforward, it just requires two numbers. Gamma is a little more involved. Vega is also a little more involved. Theta is the most involved one. As you can see, the formula is very long for theta, and hopefully you saw that on the slide as well. And then you have rho, which is fairly straightforward. So I'd like to point out one other thing as well that that is important. That is actually different here to the formulas that we saw in the previous slide. And basically what's going on here is that for theta and for rho, alright, I've added something which is not on the slides. So I've added this divided by 365 over here, okay, and then for rho I've added this divided by 100, and I just want to explain what that means. So when we talk about theta, we're looking at how the option prices change as time to expiry changes, right? So it's the time decay. So as time passes, what does the option value change by? Now, in the Black-Scholes model, time, t, is expressed annually, right? So if you remember, we have days to expiry, which is 30 days, and then the t over here is that 30 divided by 365, right? So we express this annually. So when you actually calculate this theta, you're actually getting an annual figure. You're getting what happens when t, capital T, changes by 1, which is 1 year. So to convert this into a daily number, you want to divide it by 365. Then it gives you the decay per day rather than the decay per year. Okay, so that's just one difference in the calculation. This is standard, is what people use. They'll always calculate it per day rather than per year. Okay. Likewise with rho, rather than doing, one a change of 1 in the interest rate, we're looking at a change of 1% or 1/100th. So that's why we divide it by 100 again. Again, this is kind of standard stuff that we do. Again, I wouldn't worry about too much of the formulas. If you want to get into them, you can, but you don't need to. You can just use this calculator as it is. Okay, so this is now the Greeks for this particular set of parameters, which is the same one we worked at last time. So we have the current stock price of 100, we have the strike price of 100, the interest rate of 8%, dividend yield of 1.5%, annual volatility of 25%, and 30 days to expiry. All right, so let's go through and understand what all these terms mean. So this is just the price. So delta is 0.54. And remember I told you at the money deltas are close to 0.5. Turns out for calls they're slightly above 1.5, and for puts they're slightly below 0.5. But the delta is telling you how much the option price will change when the underlying changes by 1 unit. So if the stock price were to go from a 100 to 101, the call option would increase by 0.54. Okay, that's what the delta is telling you. Likewise, the delta for the put option is telling you what happens to the price of the put when the stock goes up. Stock goes up by 1. Well, the price of the put option falls by 0.45. And we can almost, I'm going to actually look at this in more detail, how the changes work. But basically, one thing that we know is that, as I told you, at-the-money calls have deltas about 0.5. Once you have an in-the-money call, the delta becomes close to 1. And the in-the-money put, the delta becomes closer to -1. So suppose now, instead of the stock price being 100, it was, say, 103. Okay? Now, when it's 103, the call option is in the money. Before it was at the money. So you can see the call delta is now almost 0.7, so it's gone closer to 1. Meanwhile, the put option is now out of the money because the stock price is higher than the strike, so this has now gone towards 0. Okay? Likewise, if you had a current stock price of 97, now the call is out of the money, so it's gone again towards 0 from 0.5, and the put is now in the money, so it's gone more towards -1. Okay, so you can see how the delta is different depending on whether the option is in the money, at the money, or out of the money. Okay. So the next Greek is called gamma, and remember I told you that gamma is basically the same for call and put options, so that's why it's actually the identical formula for both of these. This gamma is telling you that as the stock price changes, how does the delta change? So this is saying if the stock price were to go up by 1, how much would the delta change by? So the delta right now is 0.54. Delta would go to 0.54 plus this if the stock price were to change by 1. Okay, so that's what this gamma means. And I told you gamma is highest for at-the-money options, lower for out-of-the-money and in-the-money options. So this is, let's say, the at-the-money value. If we have an in-the-money option, then this gamma falls to 0.047. And again, if it's the other way, then again it's a little bit lower than what it was before. Okay, so at-the-money tends to give you the highest value of gamma. As you can see, gamma doesn't change very much. It's kind of pretty similar even as we vary the stock price. So it's not a variable that changes as much, say, as delta does. Okay, next we have vega. So vega, as I said, refers to what happens to the price as the volatility changes. And again, you'll notice that this is divided by 100. Okay, and like with rho, the reason we're doing this is because we want to look at a 1% change in the interest rate, right? Sorry, a 1 percentage point change in the volatility, right? So we're looking from saying the volatility going from 25 to 26%. So that's actually a change of 0.01, but it's not a change of 1, because this becomes converted into a decimal. So again, with vega and with theta and with rho, we're dividing by a number to kind of standardize the calculation, so it's easier to interpret. Okay, and that's because volatility typically goes up by 1%. It doesn't go up by 1, which is equivalent to 100%. So this vega is telling you that again, as the stock price, if the volatility goes up, what happens to the value of the option? And it's positive for both, right? And it's the same formula as well, which is telling you that as the option value goes up, then as the volatility goes up, then the price of the call option would go up as well as the price of the put option. And again, vega is not going to vary much if we're at the money or out of the money. So for example, if I make this 97, vega is a little bit lower. If I make this 103, vega is also a little bit lower. So vega again tends to be high when you're at the money. It tends to be less important when you're out of the money or in the money. It also depends on other things like time to expiry. So for example, we have 30 days to expiry. If we had 20 days, then the vega becomes less important. It goes lower, and if we had say 5 days, then the vega becomes even less important. Right, so there's a nice inverse ratio between vega and time to expiry. So say we had 60 days, then the vega becomes higher. Now it's 0.15. Right, so vega will be higher when there's a long time to expiry. Intuitively, this makes sense because vega is looking at the changes in volatility over the life of the option, and the longer the option has remaining on it, the greater the impact of a change in volatility, right? Because the stock's going to be moving around for a longer period of time. So that's kind of intuitively why vega gets bigger when you go have a longer dated option. The next one is theta. So this is the time decay. So this is expressed as a negative number. So normally with all of these, we're looking at increases in the parameter. So here we're saying delta is what happens when the stock price increases by 1. This is saying what happens to delta when the stock price increases by 1. This is saying what happens to volatility, what happens to the option price when volatility increases by 1. So theta is the only one that's the opposite. It's saying what happens to the option price when time to expiry decreases. Alright, so time to expiry, say, goes from 30 to 29 days. And this is intuitively sensible because we want to know what happens as the option approaches maturity, right? Because T is always, the time to expiry is always dropping every single day. So what this is telling you here, so these brackets mean it's a negative number, that this option will lose 0.056 per day. Okay, so from day 30 to day 29, assuming nothing else changes, remember the all-important assumption that everything else is held constant, then the option will decay by this amount. And then the put option, you can say, is also decaying by a smaller amount. Likely this is because the put option is actually worth less, so it has less to decay. Theta also increases as time to expiry gets near. So right now with 30 days to expiry, you can see the thetas are 0.056 and 0.038. If I make this 20, then this increases to 0.067, 0.049, and so on. If you get very close to expiry, say 5 days, then the theta becomes really high, right? That becomes 0.12, and this becomes 0.10. So theta, the time decay gets larger and larger as you get close to expiry. Okay, and if you had a long dated option, let's say 90 days, then you can see the theta has gone down. It's much smaller, right? So the further away an option is, the smaller the theta is. When the option gets close to expiry, its theta starts getting bigger. The final one we have here is rho, and rho is measuring what happens to the option price when the interest rate changes by 1 percentage point. And hopefully you can see that rho is very small. So it's 0.04, which means the option would increase by 0.04 if the interest rate were to go up by 1%. This is small simply because interest rates tend to not move that quickly. So typically interest rate is unlikely to go up by 1% in a single day. So if you were looking at just an even smaller change, then this would become minuscule. Alright, so this is why I said rho is actually not as commonly used. It's not as important. So even though, say, theta and rho are kind of similar in magnitude, that's 0.05, this is 0.04, theta is saying what happens each and every single day, right? This occurs each and every single day. So it adds up to a lot. Whereas this occurs when the interest rate goes up by 1%. And the interest rate doesn't really go up by 1% very often, where that's actually a very large change. Typically a central bank will move interest rates by 0.25% at a time, and they'll typically do it every month or every 2 months. They won't do it that frequently. So again, it's there for completeness, but as I said, it's not used as often. In the final part of this lecture, I'd like to talk a little bit about some of the limitations of these option Greeks and kind of how and when to use them. So the first thing to note is that option Greeks are approximations only. Okay? They don't tell you the exact change, they only give you an approximate change. And they're actually only valid for small changes in each parameter. Right? So what this means is that let's say I'm looking at delta. How does the option price change when the stock price changes? So the delta is an approximation that'll be valid only for a small change in the stock price. Okay, so it won't necessarily work for a large change in the stock price. One reason for this is that for those of you who have a mathematical background, a lot of these calculations are derivatives, right? So we're taking the derivative of a function, and the derivative changes depending on where you are, right? So the derivative's only valid for small changes, right? So if you've ever done math or calculus, then you'll know what I'm talking about. If you haven't, that's okay. But basically, what to take away from this is that the Greeks are only going to be valid for small changes in each parameter. So there's a couple of times where you shouldn't use them. One is when you're looking at large changes. For large changes, the Greeks are not as useful. And what we're going to do is we're going to go into Excel and actually kind of show this to you. Another time where they're not as useful is when options are very close to expiry. This is actually more because when options are close to expiry, its price changes a lot faster. Its delta changes a lot faster. So because you're so close to expiry, even when there are small changes, the option Greeks can become invalid, right? So it's kind of a similar idea, but basically when options are very close to expiry, a lot of the Greeks are very volatile and they're not necessarily very useful. Okay, so by useful I mean, like, can you actually use this when you trade, right? So one of the things we do, for example, with the Greeks is delta hedging, right? We will hedge we might buy a series of options that have a net delta of 0. Okay. Now, when the options are very close to expiry, those deltas can change very fast. Okay, so even small movements in the stock price can result in big changes in delta, and then you're no longer delta hedged. Whereas when you're further away from expiry, that delta hedge is going to be, it'll last for longer, right? The deltas won't change so quickly. So this is why when options are very close to expiry, when you see, for example, delta of an option close to expiry, it's not as reliable because it can change very quickly. Okay, so that's kind of the reason why it's less useful when options are close to expiry. And the final limitation is that all the Greeks are based on the Black-Scholes model, which itself is in itself an approximation to the live market. Right. So we saw in the previous lecture how the Black-Scholes model is only an approximation. Right. It's not the reality. And all of these Greeks come from that Black-Scholes model. Right. So not only are the Greeks approximations within the model for small changes, the model itself, the Black-Scholes model, is an approximation to reality. Okay, so it's important to keep that in mind, and don't take it as being the final definitive answer, but again, treat it as an approximation. That's very important. I think what is important to take away from this, treat the Greeks as approximations and only use them for small changes in each parameter. Right, so now we're going to go into Excel, and I'm going to show you how the Greeks can be used and how it differs when you're looking at small versus large changes. Alright, so on this third tab, it's very similar to the last tab we looked at, except I have these two tables that I've put in here where I'm kind of showing you how good of an approximation the Greeks are relative to what actually occurs. Okay, now these are not all formulas, these are numbers manually entered in, and basically what I've done here is that I've essentially taken the approximation based on the Greeks and looked at the actual change and then computed an error, which is the difference between the true change and the change implied by the Greeks. Okay, so I'll show you one example how I did it quickly, just this first one. So this is a small change, so this is a change of 1. So I'm saying what happens when the stock price goes up by 1. Okay, and delta tells you what happens to the price of the call option. So we're doing the call option as an example when the stock price goes up by 1. So this is the initial value of the call option, right? 3.1216, which is right here. Now, the delta is 0.5433. So according to the Greeks approximation, if the stock price goes up by 1, the Greeks should be this 3.1216 plus the value of delta, which is 0.5433. So according to the Greeks approximation, if the stock price were to go up by 1, that will be the new option price. Now what we can also do is actually just calculate the price assuming the stock price goes up by 1. Okay, so I do this, and then I get 3.6922. So this is that actual number here. Okay, so remember the Greeks was an approximation, and this is what actually happened to the price when the stock price went up by 1. Okay, and you can see they're not exactly the same, right? According to the Greeks, it should have gone up to 3.6649, but the actual, what it actually went up by was 3.6922. Okay, so this is the difference between the two. This is the error, and you can see it's pretty small. It's about 0.02 rupees, which is not very large, and this is a small change. So the Greeks are a good approximation when it's a small change. And then we run the similar exercise for the other Greeks. So here for gamma, I'm asking what happens to delta when the stock price changes by 1. Okay, so how much does delta go up by when the stock price changes by 1? So the initial value of delta is 0.5433. Okay. According to the Greeks, delta should go up by this 0.0553 if the stock price goes up by 1. So according to gamma, the new delta should be 0.5986. Now what's the actual change when the delta were to go, or when the stock price goes up by 1? So I can put this in here. The delta actually goes up to 0.5977, so that's the new actual delta, and this is the difference between the two. So it's pretty small. Okay, so you can see that it's in that sense a good approximation. Okay. Now let's look at Vega. So Vega will tell you, so here I'm saying what happens to the price of the option when volatility goes up by 1. Okay, so let's get this back to 100. So the initial value again is 3.1216. According to the Greeks, sorry, I'm over here. According to the Greeks, a 1 point increase in volatility should increase the option price by 0.1135. So it should go up to here. Let's see what actually happens if I were to change the volatility from 25 to 26%. It goes to 3.2351, which is actually the same. So there's actually no error in the Vega. There will be a tiny error, but it's going to be many decimals out, so we don't have to worry about it. Okay. The final one is, sorry, the next one is theta. So here I'm saying what happens to the option price when 1 day passes. So according to the Greeks, it should fall by 0.0563. If I were to actually do the change, then you'll see that the new option price is 3.0649. So there's an error that's also extremely small. Alright, so theta then becomes, as you can see, a pretty good approximation. And with rho, it's the same thing. I'm going to increase the interest rate by 1 point. So this is going to go from 8 to 9. According to the Greeks, it should go to 3.1637. The actual change value is 3.1638. And the error is again pretty small and negligible. Okay? So this is what happens when you have a small change, right? It's a change of 1 for each of the items. And you can see there is still some error, right? It's still an approximation, but the error is fairly small. Okay? But what happens when we do a large change? Well, here is when things get a lot worse, right? We'll see that the Greeks are actually a really poor approximation of a large change. So suppose now instead of the change of 1, we're going to look at a change of 10. Okay, so suppose, for example, the stock price goes from 100 to 110. Now, according to the Greeks, okay, the stock price should go to 8.55. It actually goes all the way to 10.79. Okay, So there's a huge error of 2.237 here, right? That's very large. Like that's almost 2/3 of the value of the option price, right? So as you can see here, this delta is really not reliable when you're looking at a large change. Okay, so particularly delta is the one that gets thrown off the most. The other ones also have large errors, but none as large as the delta. Okay, same thing now looking at the gamma. The stock price goes up by 10. So this is saying what's happening to delta, remember? According to the Greeks, the delta should go to 1.09. So this we know is wrong because we know that delta has to be between 0 and 1 for a call option. So we already know this is not correct without even doing any calculations. The actual delta goes to 0.924, as you can see up here. And this again is a pretty big error, right? This is the error in delta. So that's 17% out of the delta value is wrong. So this is also a big error. Okay, and again, clearly it's not valid for a large change. Then we run the same exercise with Vega. So let's go back to 100. And this time I'm saying that the volatility goes up by 10%, so it goes from 25 to 35%. Here you can see the error is actually not that large. It turns out the Vega approximation is quite good anyway. So we still get a larger error than 0, which is what we had before, but the error is not very big. And that's partly because Vega itself is not a huge component in terms of determining the option value. The next one is theta, and here you can see the error is also quite large. So if I were to look at 10 days later, so 10 days pass, according to the Greeks, the option should be worth 2.55. It's actually worth 2.51, so the error is 0.048. This is also quite large. It may not seem so, but this, when you're looking at time decay, it's quite big. So again, this theta is not really valid for a large change. And the final one we can look at is rho. As you can see, rho has, this time I looked at a 10-point change in the interest rate, so 18 to 18%. There's a pretty large error, it's 0.0166. Because rho itself is not that important, the error is not that large. So again, you don't need to worry about that one. But hopefully what you take away from this is that, you have, the Greeks are really valid for small changes only. Okay, so don't use them for large changes because you get very large errors. And this is just the error within the Black-Scholes model, right? This is not even taking into account the fact that the Black-Scholes model is itself an approximation. Okay, let's now go back and we'll conclude our lecture. So this lecture was all about the option Greeks. We talked about delta, gamma, vega, theta, and rho as the Greeks that we looked at. These are the ones that are most important and most commonly used. There are more if you're interested in looking at them. You can just Wikipedia them. And then we also spent the latter half of the lecture looking at an Excel calculator. So we saw how to calculate the Greeks for each of the options. I highly encourage you to download this Excel sheet and actually play around with it yourself. You can, you can look up the Greeks for various different options that you're interested in, and so on. And use it. You can see what happens with different changes. Finally, we talked about small and large changes, and I talked about how the Greeks are really only valid for small changes. That when we looked at larger changes, the errors were a lot bigger. Okay. And again, I encourage you to look at the calculator. One thing you can try, for example. So, for example, I told you that when options are close to expiry, the Greeks are not as useful. So what you'll see in practice is that when the options near expiry, the difference between small and large changes becomes even bigger. The errors become much bigger. Okay, so when you're far away from expiry, the errors are smaller. When you're closer to expiry, the errors are bigger. So that's what we mean by it not being as useful. Okay, so this concludes our lecture on the Greeks. Next lecture and the one after that. Yeah, sorry, that says lecture 7. The next lecture is actually lecture 9. My apologies for that. That lecture is on implied volatility. We'll have 2 lectures on this. There's part 1 and part 2. and these two are quite important. You see implied volatility a lot in practice, and I use it a lot as when I'm trading as well. Alright, thank you very much for listening, and I'll see you in the next lecture.